One tool I always want to point out on days like this, of course, is our stock repair tool. It's a very useful tool if you have a stock that's down in price, maybe recently just got into a stock and it's, of course, pulled back today. You might not expect it to continue down. You might expect it to recover. But we can take Fabrinet as an example as it pulled back today. So let's just take a look at, go back to the stock detail page. We'll just look up Fabrinet. Let's go ahead and take a look there. So we see it's down 348. Let's go back previous day. It was at 66.52, the close of yesterday. Let me go back one more. 66.81. There we go, 67.52. And this was on January 28th, okay, after that first pullback. So why am I going to this date? Well, what I wanted to show you is even though it declined more, and yes, at 67.52 when Fabrinet was at 67.52 on the 28th, that probably would have been the best time to do that income method number 3 position, and I would have had the risk lower than 1%. I just thought it was going to continue to move up in price a little bit more. Not going to say I missed the window, but I could have done that at that time. But let's say that on January 28th, I decided to get into Fabrinet at the high at 67.52. It's not a bad drop, but with the stock around 63 right now, can I do a repair? And the answer is most likely. So let's take a look here. We're going to take our price of 67.50, and we're going to say we just purchased 100 shares. So this is the stock repair tool, and what it's going to do for me is try to build a ratio repair. This tool went out and looked at all available expirations going out in time, and it tried to build ratio credit spreads for me to use that can help me get back to break even. The stocks, we bought it at 67.50, it's at 63.04. We have a $4.50 loss on this position. But you see here we have an April repair. Now, couldn't find a repair for us in February, couldn't find a repair for us in March, but that's okay. Here's an April repair where it's showing me that the break even is now 63.25, pretty much right where the stock is trading. Well, how does that work? Well, let's click on repair details. And what this repair would be is it shows me that I could buy an April 60 strike call, 3 points in the money for $7. And then we could sell 2 April 65 calls for $4. This would give me $8, so I'd have a net credit of $1. I like it when the math is easy for us. So what did that mean? That means that right away we've reduced our net cost from $67.50 down to $66.50. Well, how's my break even $63.25? Essentially what we've done is entered into a bull call debit spread with a 60 call that we purchased and a 65 call that we sold, and a covered call on the stocks I own and the additional 65 call. Which means if the stock is trading at $3.25, the 2 calls expire worthless, and I can sell to close the long call that I was essentially paid to own for $3.25. So I get $3.25 back from the long call, the dollar from the initial net credit, that's $4.25, which is exactly at $63.25, my loss from the purchase price of $67.50. So at April expiration, the stock's still just trading at $63.25. I'm back to break even though my cost basis was $67.50. That's the stock repair. That's how it can help you on days like this. Now, true, this was a sudden event. The market's been strong, although as Sam mentioned and we've been mentioning for the past few weeks, there have been signals of a easing being needed from the gains that have been going up. I would love to see a March or a February repair in this situation, but again, the April one's not bad. Gets me back to break even where I only need a small movement in the stock and I can still make 5.3% if it goes above both strike prices. What would I have to do then? Well, I deliver my shares of Fabrinet at 65 for the covered call obligation, even though I paid $67.50, but then I'd get the full 5 points back from that bull call debit spread that's nested in there as part of that ratio. Buy the stock essentially at 60, sell it at 65, get 5 points back, and we keep the dollar net credit. So it'll still be a 5.3% return, even if the stock at 63.25, 63.50 is 4 points below. I'm sorry, I apologize. It'd be a 5.3% return if the stock's above 65, still 2.5 points below our purchase price. So that's how the stock repair can help you in this situation. Downfall of the stock repair tool, what does it not do? It does not solve the problem if the market continues down. And that's when you'd want to try to buy a put on your position to try to lock in some of the gains as well.